It is my pleasure once again to welcome you to this accounting class. Course this moment is Principles of Financial Accounting. Our course code is ACC211. It is a course meant for accounting students of the University of Lagos, Department of Accounting. And today we are looking at incomplete records. It is expected that at the end of this class that each student will have a good understanding of incomplete records in accounting, appreciate features of incomplete records, and know how to calculate capital. At the same time, we'll be able to determine total sales and purchase from incomplete record, know how to determine total purchase from incomplete record, appreciate the impact of drawings on capital and profit of the entity, determine figures to be used for expenses, compute profit with the use of markup and margin. Now, what do we mean by incomplete records? Incomplete records are referred to as financial records that do not follow the double entry principle. In accounting, it's expected that every transaction that is being recorded will be done in a twofold manner: one debit and then the other side credit. But in this case, when we talk about incomplete record, we're talking about records being kept in an informal, accounting system. In which case, some businesses keep only those records that are they deem necessary and not attempt to record, the dual aspect of each transaction. So in some cases, only personal records of debtors and creditors, car sales and purchases and cash expenses are kept, whereas there are no records for other transactions. That is what we talk about here. Now, when we talk, let's look at the features of incomplete records. What are the features of incomplete record? Number one, it does not follow the double entry principle in accounting. It does not follow the double entry principle of accounting. So what does that mean? It means that records of transactions are not being made in a very systematic manner. Rules of accounting are disregarded as much as possible. Number two, what is the feature or what are the features of incomplete record? Number two, it is a system of accounting that mixes up both business transactions with personal transactions of the owners. That's it's saying that in most cases, the transactions of the owners are not differentiated from the business transactions, and that what it means that the business entity concept is not being applied. Number three, majority of the figures and balances are based on the memory of the owners, hence they are estimated. Okay, as a result, reliance on accounting records are quite limited. And then number four, this type of system is very common, suitable, for entities that are very small. Okay, what is the challenge before us? The challenge before accountants is how to prepare financial statements from such records. So we're saying that irrespective of the fact that you have to keep, they keep records in an informal system or in an informal way, you still have to bring out records that will enable you as an accountant to be able to prepare financial statements from such records. So what is usually required is to determine or calculate some missing figures for accounts that are relevant for the preparation of financial statements. So in most cases, experienced accountants make use of balancing figures or percentages to arrive at the balances to be used. Now, let's look at the first aspect of our income record that we'll be dealing with tonight. The first one is calculation of opening capital. How do you calculate your opening capital? Let's look at the definition. Opening capital is the excess of the cost of value of assets over liabilities. It is derivable from a statement known as statement of affairs. So that is what it says. So statement of affairs is a list of assets and liabilities and their values as at a particular date. Let's look at an illustration here, saying that, for example, Dixon Enterprises had the following assets and liabilities as at January 1, 2019. We have some of the assets listed there: plant and machinery, 20 million, motor vehicles, 15 million naira, inventory, 1,950,000, trade receivables, 4,954,250 naira, investment, 550,000, cash, 586,350, trade payables. So we have the figures like this, there. Now let's look at how to prepare the financial statement, which is being required that we do even right now. Okay, so let's look at the statement of affairs as at January 1, 2019. So all the assets are listed, okay, with their accompanying balances. All right, so motor vehicles, plants and machineries, inventory, trade receivables, investment, cash. Okay, the total assets listed here for this particular exercise is 43,040,600 naira. Now let's look at the liabilities. Trade payables 2,455,250, and then accruals, that's unpaid rent, is 1.4 million naira. So adding the two together will give you 3.907,350,000. Now, in order for you to calculate the opening capital, you need to deduct the liabilities from the assets. So here we have 43 million, and then you have 3 million being deducted from 43 million. That will give you 42,643 naira thousand rather 250 naira. So that's the opening capital for this particular owner of the business. So let's go and look at another aspect of incomplete records. So how do we calculate profit from incomplete records? How to calculate profit from incomplete records? So we're looking at another aspect of this particular topic, this moment. So let's look at the illustration number 2. A sole trader had a total asset worth 1.5 million naira and total liabilities of 450,000 naira as at January 1, 2018. During the year up to December 31, 2018, Adrao introduced additional capital of 350,000 and made a total drawings of 105,000. As at December 31, 2018, Mr. Adrao had a total asset of 2,015,000 and a total liability of 150,000. We are required to calculate Adrao's total profit for the year ended 31 December 2018. That's our requirement. That's what we're required to do. Hint for this particular illustration is for you to know how to calculate the opening capital, and then of course know how to calculate the closing capital. When you have the two, you deduct the opening capital from the closing capital, and so that will afford you to know that every increase over the initial capital will be tantamount to the profit. Let's look at the solution here. So let's look at the solution. Calculate the opening capital. So you deduct the liabilities from the asset. So we have 1.5 million naira minus 450,000. That will give you 1,050,000 naira. So you add additional capital introduced into the business. That's 350,000 naira. That will give us in total 1.4 million naira. So you deduct drawings of 105,000, and that will give us a net opening capital of 1.295. That's plus the capital introduced along the line. Now let's begin to look at the closing capital. The closing capital is assets, and that's what we have here. All right, then minus liabilities, which is 150,000 naira. By the time you deduct the two, this one from the other one, we have 1.8 million. So at the end of the year, the closing capital for Adrao Limited, or enterprise, will give us 1.865. Then you deduct the opening from it, and that gives us 570. So the difference automatically means that we have a net profit of 570,000 naira. Okay, let's go to another aspect of what we have here. It means we're looking at calculation of sales. How do you calculate sales from incomplete records? Okay, you must note one thing here. Sales are made up of cash sales and credit sales. Sales are made up of cash sales and credit sales. What is a cash sale? A cash sale basically is sales made based on cash. So it means that as we are selling, we are collecting money immediately. So that's a cash sale. What about credit sales? Credit sales means that if you develop into receivables, you sell on credits. That means you sell with the hope of collecting the money at a later time. That's credit sales. So when we look at in this concept, we say cash sales will include the amount lodged into the bank and other payments made out of cash, total cash takings. This is not difficult to ascertain or calculate. However, for credit sales, the amount is derived at after considering and adjusting for some variables, and this include cash collections, opening trade receivables, closing trade receivables, write-offs, if any. Now let's look at a practical example here. Calculation of revenue, that's sales. Okay, illustration number 3. Mr. Solution, the managing director of Happiness Venture, has provided the following information concerning his business sales for the for January 2019. So in this particular month, he banked a total amount of money of 125,000. Out of which he spent, um, 100,000 on student school fees. Remember, we talked about one of the features of economic records is the fact that business transactions and personal transactions of the owners are usually mixed together. So he took 100,000 and paid his student school fees with it. He also used 55,000 naira for his own personal, errands, as it were, and then he paid wages for staff of 45,000 naira. He also disclosed, at the end of the day, trade debtors figure of 350,000, and then cash collected from debtors 850,000. Total debtors as at January 31st, 2019, 750,000. Bad debt rating of 200,000. Cash discounts allowed to debtors 120,000. So we are required to calculate his total revenue at the end of the month, January 2019. So let's look at the way what will turn out to be. Okay, what will turn out to be. The first one here is to ascertain. What you have to do is to ascertain the total cash sales. Total cash sales. Remember, he banked some, he spent some. So that means that you're going to add the what he spent to the amount that he banked for you to know the total amount of money that came in as cash sales. So he banked the total money of 125,000. He spent 100,000 on school fees. He also spent 55,000 naira on himself. He also paid wages of 45,000 naira. Okay, paying staff for 45,000. At the end of the day, he spent 195 out of sales, the cash takings. So you're going to add the total amount of money banked with amount spent out of the total sales, and that will give you 320,000 naira. Okay, so you're going to add your credit sales to it, and total credit sales, for that month was 1,570,000 naira. How do I arrive at this? I see below. Let's look at the accounts that has been prepared for the purpose of determining the credit sales. Now we have to cast our mind back to our control account or total debtors account. Okay, a control account. So we're looking at debtors aspect even right now. Now, in this particular case, there was a balance brought down figure. Okay, that's the opening balance at the beginning. Remember, this is what we did initially. The question. Total the trade debtors as at January 1, 350,000. Cash collection 850. Total debtors at the end of the month 750. So let's go back and see our solution here. So the balance brought down of 350 is here being debited to the debtors control account. Okay, remember they collected 850,000 from the debtor, so it's coming here as a credit figure. Okay, credited to this account. Okay, and then bad debt written off, of course, must be taken out. Okay, so that's the bad debt of 200,000 written off, and then cash discount of 120,000, being on the credit side here. And then we have a balance carried down, balance at the end of the month of 750,000. So that 750 carried down here will also come down as balance brought down of 750 on the other side. That's on the debit side of debtors control account. So that will leave us with 1.9 million, 1.920,000, and not 1,920,000. Okay, and then we, of course, he came up with at the beginning of with a total balance of 350. So there's need for us to deduct 350 from 1.920. Okay, so at the end of the day, we are left with a balancing figure of 1,570,000. So that is where we got our total credit sales. So by the time you add total credit sales with the cash sales, that will give you 1,890,000. So that's how to determine our the sales, at the end of the month. Now let's go to calculation of purchases. Okay, this is also made up of both cash purchases and credit purchases. All right, I say usually there's no problem with cash purchases, but where adjustment will be needed to be effected will be for credit sales. Okay, now let's look at this other illustration number 4. The following information was given by the owner of Balo Enterprises. Now, cash purchases 560,000, trade payables at the beginning of the month 250,000, trade payables at the as at January 31, that's end of the month, 750,000 naira. Payment to creditors 600,000 naira. Discount received 50,000 naira. Now let's look at the solution here. Okay, total purchases we already know will mean cash purchases and credit purchases. So for us to be given a total figure of 560,000 as our cash purchases, and then the ability to calculate our credit purchase to be 1,150,000 naira. How do we arrive at that? Now let's go to our purchase control account. Okay, like we did for debtors, we're now going to be also be having a purchase control account. Now remember, it's a liability, so balance brought down will maintain a credit balance. So we have 250,000 naira, there. Total amount of money paid, or paid to our creditors, paid to the those who supply goods. Okay, total for that amount was 600,000 naira. Total discount received, okay, 60,000 naira. Okay, and balance carried down, that's because also a credit balance, so you're going to have a debit, a credit balance CD on the debit side, and then balance brought down on the credit side, meaning that it's going to be a credit balance at the end of the day because it's a liability. So what's the balancing figure here? It's 1,150,000 naira. By the time you deduct 1.4 million naira, I deduct 250 from it, so you're going to have 1,150,000 naira. So what does that mean? By the time you add the two together, 560,000 plus 1,150,000, that will fetch us 1,710,000 naira. So that's how to determine total purchases, from incomplete records. All right. So what about drawings? Okay, say drawings are total amount and goods withdrawn for the personal use of the owners. So they also include the owner's share of expenses paid for by the business. So the part of this will be multiplied in the capital formation of the entity, as it will reduce the end of year capital. Now let's look at how to calculate expenses. Of course, we know that for every entity there will be some expenses that will also be incurred in course of running the business, or of course also making sales. Now, expenses will be calculated with reference to its accrued, and prepaid elements. Okay, where any of such occurs, appropriate adjustments are made, okay, and arrive at what, in order for us to arrive at what should be taken as the actual expenses into the income statement. So let's look at expenses with reference to accruals. All right, so this can be likened to the treatment given for calculating credit purchases. So let's look at illustration number 5. It says Sanjay, a trader, made the following details available to you. Salaries payable. Remember, this is not a liability. That's why we're talking about accruals. Salaries payable as at January 1, 2015, a total of 125,000. Salaries payable as at the end of January 2015, 150,000 naira. Payment paid, or payment made rather, during the period 720,000 naira. Calculate the amount that should be taken as salaries for the period. So let's look at the solution. Okay, here now we have salary control account. That's what it means. All right, so balance brought down, that because it is a liability, it's going to maintain a credit balance. Okay, make payment during the year 750,000, because it's coming out of cash, so debit will enter salary control account. All right, so balance carried down, because it's still a liability, we have balance carried down above the line 150,000, and below the line BD 150,000 naira. So at the end of the day, you have 870,000, out of which you're going to deduct the balance brought forward or balance brought down of 125,000. So when you look at the difference, it is 745,000 naira. So at the end of the day, your salaries to be taken, the amount to be taken as salaries will be how much? 745,000 naira. That is the balancing figure between this and the total figure here. All right, let's look at where prepaid account or amount is involved. All right, we're saying here illustration number 6. The following details have been provided by Mr. Blacksmith Enterprises regarding her rent. Regarding her rent for 2019. Okay, January, rent paid in advance 125,000. Okay, at the beginning, rent paid in advance at the end 350,000 naira. Rent paid during the year 820,000. Calculate the amount that should be taken as rent for the year, or for the period rather. So let's look at the solution. Rent control account, that's also going to be having. Now balance brought down 125,000. Okay, and then balance carried down, because also a prepaid amount, so we're going to be having a balance brought down figure of 350. So balance CD here carried down, and then balance brought down of 350. So at the end of the day, remember, a total amount of 820,000 was paid, okay, during the month of January. So adding it together will give you 945,000. But remember, we have to deduct 350,000 from 950 to give us 595,000 as the amount to be charged to income statement as rent for the period. Okay, that's closing that particular aspect of it. Let's come back. Let's go to markup and margin to say that how do we determine profit using markup and margin. Okay, now profits could also be determined by way of markup and margin. That is calculating profit on the basis of percentages. Okay, when we talk about markup, we're referring to percentage on cost. Okay, and once the cost is given, one could apply a particular percentage to know the markup and, of course, to determine the profit. All right, so let's look at this example. We said, what is the gross profit of 20% markup on the cost of sales figure of 100,000 naira? What is the gross profit of 20% markup on a cost of sales figure of 100,000 naira? The answer is simply 20,000. So that's 20% of 100,000. That is give you 20,000 naira. So when you mark up, it gives you a profit, the gross profit, and using a particular markup percentage. Now let's look at margin. This is expressed as a percentage on sales figure, which is usually cost plus profit. Okay, in this case, a percentage is also applied to ascertain the profit element. What we're saying here is that when it comes to margin, we're looking at a percentage on the sales value. All right, so let's look at this example. Said as per the above example, that's the one we had, we used earlier on. Given a sales figure of 120, what would be the cost of sales? Okay, having been given 20% as markup percentage. Okay, so what would be the cost of sales? As a matter of fact, what should be the profit? Okay, now we have figures given to us as sales figure, not as cost this time around. So we're going to be talking about margin, but then we'll be given a percentage in place of markup. So what do? They said there is need to convert the markup to margin. Okay, there is need to convert the markup to margin percentage by adding the numerator figure of markup, that's 1, to the markup denominator. Okay, we're saying here that there is need to convert the markup to margin by adding the numerator figure of the markup 1 to the markup denominator. Okay, and that is 1 over 5 plus 1. Okay, you are adding 1 to the denominator. You adding the numerator to the denominator. Okay, and that will give you 1 over 6. Applying 1 over 6, okay, 1 divided by 6 to 120, put as we give it to us as 6 value, that will give you 20,000 at the end of the day. So that means that you're getting 20,000, and then you're having 20,000 as the profit, there. So let's look at this practical example. All right, Mr. Sampson sales for the year ended 31 December 2020 was 900,000 naira. He gave further details concerning his activities for the year as follows: opening stock 150,000, purchases 650,000, markup 20,000. Closing inventory could not be provided as a result of fire incident that destroyed the inventory towards the end of the year. Calculate his closing stock at the end of the year and gross profit as at 31 December 2020. Now look at this scenario. Opening stock 150, purchases 650, markup 20. Remember, it's called markup here. Okay, so what do we do? In this case now, we'll be giving the total sales, no figure as per the closing inventory. So in order for you to determine your cost of sales, you will not be able to do that because you don't have closing inventory. So let's look at, since we have been given a markup, let's look at the solution. Sales 900,000, opening inventory 150, purchases 650,000. So that will give us a total cost of 700,000. Closing stock, I put a question mark here. Closing cost of sales, also a question mark. Gross profit, also a question mark, because all these ones are not been determined. All right. So what do we do in this case? Remember, we're giving a markup of 20%. So in order for you to arrive at this, you need to translate your markup to a margin. Okay, so determine the gross profit based on the margin. Using our initial method, determine the margin. Convert 20% markup, that is 1 over 5, to margin, which is 1 over 5 plus 1, which is 1. That will give us 1 over 6. So gross profit will be 900,000 multiplied by 1 over 6. Okay, so that will give us 150,000 naira. So with that, we'll be able to calculate the cost of sales, okay, which will be the difference between the sales and the gross profit, and then we'll be able to calculate the closing stock, which will be the balancing figure, okay, balancing figure of the total, balancing figure between the total of purchases and opening, stock. So let's look at the solution, here, next slide. So 900,000 opening inventory, that's what we have, and then total here 1,050,000. Okay, total is 1.2. How do we determine our 450? Remember, we didn't have anything earlier on. Okay, so in order for you to determine that one, we're going to multiply, okay, 1 over 6 by this, okay, and then you have 150,000. And because you already have 150,000, that will help you to also determine our cost of sale, which will be the difference between 900,000 and 150,000. So that's why we have 750. But because you already have 750, the balancing figure between the total value of stock available will now be taken as our closing stock figure. So that's what we have, here. Okay, that's what we have here. That's bringing us to the end of this particular class. I would like that you subscribe once again, like, share this particular video so that others can also learn, via this particular medium. So you remember, we have dealt with incomplete records today. We have been able to ascertain and define for ourselves, giving us a good understanding of what incomplete records are. We also look at the objectives, okay, the features of incomplete records, and we'll try to look at what an accountant must do when it comes to incomplete records. Okay, we've spoken about the opening capital, how to calculate it, calculation of profit from incomplete record, how to calculate sales, how to calculate revenue, how to calculate purchases. Of course, we look at drawings, we also look at expenses at the end of the day, whether it's coming up with accruals, also coming with prepayment, and then also look at how to determine profit using markup and margin, as a percentage given to us in any question you are being asked to answer. So that's what we need to do, and we look at the other examples that will help us, that help us to ascertain, how to calculate margin, profit via margin and markup. So once again, I want to appreciate the fact that you are here listening and of course and learning, with others this particular moment. If you have any questions, please don't forget you can use the comment box there and then put your comment there as much as possible. In next class, we'll solve a full question, for us to be able to appreciate how to actually handle incomplete records, as much as possible. Thank you once again. Don't forget, subscribe and of course like and share this particular video. Thank you. God bless you.